Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Thursday, the 17th of July in London. I'm Caroline Hepker. Coming up today, markets are rattled as President Trump floats the idea of firing Jerome Powell to lawmakers before denying he has any plans to do so. Germany rejects the EU's €2 trillion proposed draft budget, calling plans for a significant hike in spending unacceptable. Plus, can the man who cleaned up Britain's banks fix the country's wildly unpopular and indebted water industry? We have a special report. Let's start with a roundup of our top stories. President Trump is denying reports that he intends to fire Federal Reserve Chair Jerome Powell. That's after he is said to have raised the idea in a closed-door meeting with congressional Republicans that was then leaked to the press. Separately, the New York Times reported that Trump has a draft of Powell's termination letter, which was shown to lawmakers during the meeting. Bloomberg's Anne-Marie Jourdain put that claim directly to the president in the Oval Office.
So you didn't show a letter to Republican lawmakers last night?
No, I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. But I'm more conservative than they are.
President Trump added that while he doesn't rule anything out, he's highly unlikely to remove Powell unless there is evidence of fraud, in his words. The president then went on to make a series of unfounded claims about fraud related to the cost of renovating Federal Reserve buildings in Washington. Now, markets reacted sharply to the initial reports that Powell could be axed. Stocks, the dollar and long-term US government bonds all retreated, while short-term treasuries rallied on speculation that a new Fed chair would cut interest rates. Those moves were quickly unwound as Trump walked back the reports. But Bloomberg Economics says that they believe Trump is testing the markets to see whether he can fire Powell, and the sharp reaction appears to have convinced him to pull back on the firing rhetoric for now. It's a message echoed by our markets live strategist Mark Ranfield.
The more that it gets talked about, particularly by President Trump, the more traders will have to take it seriously, and you will probably see those odds start to increase. Now, it may well be that Bloomberg Economics are right, that Trump will be watching the market reaction. And if the market reaction is not too severe, then maybe that is the telling point that makes investors say, yes, this is a real possibility and it could happen sooner than later. So everybody is watching the movements in the markets, the pricing odds in the futures and the betting markets as well. You put all those together and it's beginning to look like a case of no smoke without a bit of fire.
Mark Cranfield speaking there as Bloomberg Economics modelled what replacing Powell with a more dovish chair could mean for the US economy. While making certain assumptions, the model found that removing the Fed chair could drive real US GDP down by 0.6 percentage points by the second quarter of next year, with an unemployment rate close to 5% and headline inflation, CPI, of around 3%. Well, President Trump said that he would send letters to more than 150 countries notifying them that their tariff rate could be 10 or 15%. In an interview with Real America's Voice broadcast later on Wednesday, Trump said that the rate was going to be the same for everyone for that group. Trump added that the trading partners that would receive those letters were not big countries and they don't do that much business. Asked about the prospect of a deal with the European Union, well, the president said that the US could make a deal possibly with Europe, but that he's very indifferent to it. Let's think about bank earnings too today. JPMorgan is now worth more than its three largest US rivals combined. The US lender scored $30 billion of profit in the first half of the year, and it now has $1 trillion more in assets than any other US bank. It comes as American banks posted record earnings performances, with Goldman Sachs posting its best stock trading revenue in history. RBC Capital Markets head of US bank equity strategy, Gerard Cassidy, says you can put the record performance down to President Trump's Liberation Day.
We have to remember that the markets obviously are a major factor behind the investment bank's trading revenues, and increased volatility is good for trading. It's not as strong for investment banking revenues, but for trading, you want volatility, and we certainly had that at the start of the quarter.
Well, to Cassidy's point, trading revenue at the 5 biggest banks in the US hit $71 billion in the first 6 months of the year, the most for that period ever. Opinions differed on whether it would last, though, with Goldman's CEO David Solomon saying that the coming quarters wouldn't be on the same scale, whereas Citigroup CEO Jane Fraser says that volatility will be a feature, not a bug, of the new world order. Here in Europe, Germany has rejected the European Commission's €2 trillion budget proposal just hours after it was announced in Brussels. The 7-year plan is €800 billion larger than its predecessor as the bloc tries to fund support for European companies. EU Justice Commissioner Michael McGrath told Bloomberg Radio it will be 2 years of tough negotiations ahead.
The EU, you have a lot of stakeholders. You have the 27 member states, you have the European Parliament, and it is being framed in challenging circumstances with the capital repayments on the COVID loans, Next Generation EU, beginning to be repaid from 2028. So that does place additional pressure. That could be 20 to 25 billion euro every year. So that's the first call on the budget as such.
Former Ireland Finance Minister Michael McGrath there. Germany's response to the unveiling was to call any comprehensive increase in the EU's budget unacceptable. Well, the UK and Germany are set to sign a new treaty here in London today that could include a commitment to assist each other in case of armed attack. The ceremony comes as part of a visit by the German Chancellor Friedrich Merz to the UK. Bloomberg's Ewan Potts has more now.
The UK's Prime Minister has previously talked of a wider reset grounded in a new spirit of cooperation. A senior German official has told Bloomberg today's mutual defence pledge is a reaction both to an increasingly aggressive Russia and growing concern among European allies about the US commitments to NATO under President Trump. The news comes as BAE, Britain's biggest defence supplier, said it's speeding ahead with the development of its next-generation Tempest fighter jet, proving there's competition in the defence space as well as cooperation. In London, I'm Ewan Potts, Bloomberg Radio.
Lastly, to some sports news now. Masters champion Rory McIlroy is back on home soil today for the start of golf's Open Championship, which returns to Royal Portrush for the first time in 6 years today. He says he's got a good opportunity to add a 6th major title to his collection.
I want to do my best this week to enjoy everything that comes my way and enjoy the reaction of the fans and enjoy being in front of them and playing in front of them. But at the same time, I want to win this golf tournament, and I feel like I'm very capable of doing that.
World golf number 2, Rory McIlroy speaking there. Ireland's Shane Lowry lifted the claret jug the last time the tournament was held at the course in County Antrim. World number 1, Scotty Scheffler, is favourite for the title this year, with 3-time major winner Padraig Harrington hitting the opening tee shot. So that in the golf news then this morning. Let's think about the markets though. In terms of the volatile day that we had yesterday, the threats to the independence of the Fed, the dollar this morning is back to some gains, but that was hit hard yesterday after the flurry of speculation, then denial from President Trump. The Bloomberg Dollar Spot Index this morning is up by 0.2%. The VIX Index also yesterday was above 19, given the repeated attacks on Powell. In terms of Treasury yields this morning, let's look to the 10-year yields, which are up almost 2 basis points at 4.47. The Fed's Williams talking about the restrictive stance of the central bank being entirely appropriate. Remember, European stocks yesterday dropped for a 4th session in a row, down 0.6%. There were some major names hit yesterday after results like Renault and ASML. Looking to Asia, some gains. MSCI Asia Pacific Index is up currently 0.2%. US stock futures are in the red right now. So those are the markets. Well, in a moment, we'll discuss the threat to the Fed's independence from political interference and also a special report on Thames Water and the man being brought in to fix the UK's faltering water industry. But another story got my attention this morning as I got up before the bin men to be here in the studio. The era of bragging about how little sleep you get as a top executive is over. I must say, I cheered at this. Kate Crader has been writing about the routines that CEOs have for getting a good night's sleep. And this is in Bloomberg Businessweek's The CEO Diet. Well, she has Uber's CEO Darakosh Vashahi. Pretty simple. Get rid of the screens. He says he now falls asleep by reading. Yes, wow, a book. It's back. Also, a long soak. Sam Calgione, who is a founder of the craft brewer, Dogfish Head Craft Brewery, he apparently takes a half-hour-long bath before going to bed. Daytime nappers are in there too. Vita Coco's co-founder, Michael Kerben. And then the estate agent to the rich and famous, Rainey Williams, who co-founded Beverly Hills Estates. Her list is enormous. Magnesium and zinc and an energy supplement and a long skincare routine. Anyway, it's a really good read. So I'm going to put a note and a link to that article in our show notes. Kate's story gives you, well, all of their financial vital statistics, none of the competition about sleeping being for wimps. So a really nice story today. Now, President Trump took his pressure campaign against the Federal Reserve Chair Jerome Powell to a new level yesterday, putting markets into a short-lived nosedive. Trump then denied a plan to imminently axe Powell, but he didn't rule anything out. Joining me now to discuss is Bloomberg's Markets Live strategist, Mary Nicola. Mary, good morning. Good morning. Bloomberg Economics says that President Trump is testing the markets to see whether he can fire the Fed chair. Well, what was the market reaction in more detail?
There's been a lot of volatility. So obviously we saw that the U.S. dollar was undermined. And then, of course, that we saw a steeper U.S. Treasury curve as a result. So clearly the market is unhappy with some of these noises. And as long as the idea continues to get floated, I think that you'll still see a reaction that negatively, because what he's essentially doing is undermining the Fed's credibility. He's blurring the lines between fiscal and monetary policy, and that continues to be a cornerstone for the U.S. And so as long as these ideas continue to get floated and the market reacts negatively, that's going to be a key test for how long this goes. Now, if you look at the poly markets are only pricing in about a 20% chance of Powell leaving by 2025. But again, it's going to start increasing if more of these noises come through, and that's going to increase volatility and undermine the dollar and steepen the yield curve.
Okay. Fed independence absolutely critical, says JPMorgan's Jamie Dimon. Wall Street CEOs have been commenting on this situation. A lot of them. What have they been saying?
Yeah, absolutely. They've reiterated. Each one of them has said the same thing in terms of talking about the importance of Fed independence, Fed credibility, and not blurring those lines between monetary policy and fiscal policy, and the fact that how important it is for the Fed to take action based on what it sees available. So we already heard from Fed Williams saying that, current policy is appropriate where it stands. And of course, you've had some CPI this week showing some bubblings in inflation. So clearly there is an indication that they want to take a more measured approach to policy, whereas the Trump administration clearly wants rates to move a lot lower at a much faster pace than what the Fed is thinking. And of course, there still is a lot of uncertainty out there. So you don't know the impact of tariffs that's really coming through. And then, of course, you had an increase in fiscal spending as a result of the big, beautiful bill. So there's a few pockets that are bubbling. And of course, what these bank CEOs are saying is just the importance of the Fed credibility at such a time.
The other question is about whether the next Fed president influences the board. What are the risks around the Fed board being captured politically and the US ends up with lower interest rates, which is what President Trump would like to see? I mean, we already know that the process to replace Powell is underway and his term is up in May next year.
Yeah, but the problem is it's going to be policy mismanagement. So if you end up having inflation expectations unanchored, which is one of the key jobs that the Fed is doing, or having extremely low rates when the economy is chugging along absolutely fine, and then there becomes an absolute mismanagement in the economy, and that's where investors become really, really nervous and jittery and could actually exacerbate what some of the key themes that we've seen, where the cracks in U.S. exceptionalism and also the Sell America theme that we've noticed since the start of the year. So it's a really fine and difficult line if that we start seeing that the Fed move in favor of political pressure rather than what is really being asked for by the economy and what needs to anchor growth and, of course, inflation.
Okay, Mary, thank you so much for being with me this morning. Very good to have you on the programme. Bloomberg's Markets Live strategist, Mary Nicola. So I want to turn to a story here in the UK. The man who cleaned up Britain's banks, John Cunliffe, is set to reveal his plans to fix the country's wildly unpopular and indebted water industry. Joining me now is Bloomberg's Priscilla Azevedo-Roca, who's been writing about this. Good morning, Priscilla. Look, firstly, can you just tell us now how bad the crisis at Thames Water and really across the industry is in the UK?
The crisis with Thames Water is really bad. The company is in the process of renegotiating its huge debt pile that by now it's nearing 20 billion. It's looking to inject equity at the same time. This has been dubbed, just to give some perspective, this has been dubbed as the biggest corporate recapitalization in Britain's corporate history. So there's a lot of will into making this work. The creditors of the company, which now actually own Thames Water, they're negotiating a plan with water regulator Ofwat in the company itself and the management of the company to do this recapitalization. But they are asking for a lot of concessions, and these discussions have been really heated. If they don't reach an agreement, there's a high risk on the table that this company will fall into the special administration regime, which is very similar to nationalization. Okay. So the stakes are very high at the moment.
Yes, and also the stakes are high, and therefore when you read Sir John Cunliffe's career, when you know about his career, he's held such a series of senior roles. I mean, at the Bank of England, at the UK Treasury, as a government advisor over decades. What is his task now?
That's right. He's a very seasoned civil servant, and he's been tasked by the UK government to look at the current system and make the system work. So from day one, they excluded nationalization. They excluded changes to the current price control mechanisms which is established by the regulator that sets up how much companies are allowed to spend and invest and charge customers. So basically, he was brought in, said, okay, this system is clearly not working. What can we do? What can we change to make it work without changing how things are structured? And in this process, in his findings and throughout his travels and when he talked to industry in his interim report, he indicated that he's looking particularly at the role of regulators, which is very similar to what he has done in the post-financial crisis Britain with the banks, to have more accountability. And he's also honing in on the right type of investors for the sector. And that means attracting people that want to be there for a long time. They want lower returns. They want the sector to be boring again compared to what we have now, which are investors that have a short time framework, that they are looking to extract returns, and that doesn't really work for the sector.
Okay. Water is a utility. It should be a sort of steady stream of income. I mean, critics have obviously blamed privatisation for allowing companies to extract profit at what they see as the expense of infrastructure. I mean, customers are going to have to pay. This is partly the outcry over Thames Water and why it's been so politically significant and probably will stay that way.
Yes, that's right. It's not only Thames Water, it's across the country. Bills have gone up to a record high earlier this year in April. And the issue here is that we have very, very old infrastructure that requires improvement. For years, we had the political will to keep bill lower, to keep household bills lower. There was this angle from the political side. And at the same time, we had investors that extracted hefty returns from being part of those companies. And that combination has put us where we are now. So we had years of underinvestment in a massive infrastructure that requires huge improvements, that is really, really old. We had what is considered now what the market is viewing as the wrong type of investors for this type of assets, and lower bills, which is also the political angle to this. Years of political will to keep bills lower. And we got to this point where someone has to pay the bills, right? At the end of the day, improvements are not free. And that combination has put us where we are now, with climate change, with population growth, with water needs rising. The UK regulator approved 104 billion of investment for all water companies combined for the next 5 years period. And that's the highest ever in history, which gives you a little bit of scope on how much is needed to improve the system, right? And we got to a point where we have all these three factors against it. So this bill comes at the end of the day. It's not free.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.